Hey, welcome to the exchange. In this video, I want to cover the Vroom Incorporated Investor Day presentation. This came out last May, but I didn't cover my previous video at all, so I want to cover it now and basically in detail in full. I think it was almost like a part two to that video itself, but yeah, let's go ahead and get started. So this is the Investor Day presentation. This came out last May, 2022. I'm going to link this all down below as well, too. That way you can check out in your own time, but let's go ahead and get started. So this is the entire problem with like Shift, Carvana, Vroom itself is you have a massive market here, which is $841 billion, but it is massively fragmented here. So you're looking at Vroom under 1% market share, CarMax under 2% market share, the top 100 dealers itself across the nation under 8% market share. So again, you have a massive market here, but there's really no consolidation at all. And that's the entire value prop of like, a Shift, Carvana, or Vroom, etc. Is if they can consolidate market share, even a small market share itself of this total pie, then they can get a massive profit, massive kind of operational base to grow off of here too. Now, no one's quite done that just yet in the used car market though, but that's kind of where it's going to in the general direction right now. But again, if they succeed, I mean, it could be massively profitable just based on the data and the economies of scale itself of that market. So here's a problem with Vroom, and the same thing with Carvana and Shift as well too, is they're burning way too much cash trying to grow that market share, really expand that base across the board. But right now they're choosing to slow down. They're trying to, they cannot keep growing at this current rate they're at right now because they're burning way too much cash. So they're trying to get profitable as fast as possible. And really have three key objectives here. So number one is prioritize unit economics over growth, which all that means is make cars or basically sales per vehicle, the actual net profit margin and net profit loss, make it positive. So again, if you remember my actual report, my previous video here, and they're burning roughly, I'd say 2022, roughly $7,000 per car itself, which again, this is not sustainable in the long term. It's way too much cash to burn overall too. Number two, significantly reduce operating expenses. I mean, it's the same thing for all the major used car dealers. I mean, they have to drop the cost wherever possible in order to maintain their actual liquidity itself and basically forward, survivability. Number three, obviously, maximize liquidity itself. If we had a major credit crunch or major credit crisis, in like 08 style, I mean, this can get very bad for them. And they have to maintain cash on the balance sheet in order to survive itself, which Vroom's in a pretty good spot. I mean, they have at least 12-month minimum, probably close to 24 months of basic liquidity or survivability left on their balance sheet. So they recently acquired United Auto Credit in the last few months, which is basically a financing arm of Vroom itself now. So what that let them do, basically finance or generate loans in-house. So if we had a major credit crunch or bank stop getting on auto loans, or the rates are sky high, they don't want to touch it, etc. Basically, they can go through United Auto Credit, generate those loans in-house, and keep the kind of ball rolling itself, and keep the vehicle sales rolling for some of your subprime customers. But United Auto Credit is very profitable pre-tax. I'm looking at here at $50.9 million in 2021. The total portfolio size, looking at 2021, $636 million. So it's not like a massive basic bank in a way or loan provider in a way, but it is still pretty big overall. Looking at overall liquidity itself, I mean, it is very positive right now. So this is a good sign. It's a long-term sustainable business for Vroom itself. At least the subcomponent is right here. So this next part is a securitization trust, which all this really means is basically loan portfolio size available. It's like total actual liquidity pool available. So you can see here in the latest one, it's about 2/3 of the way full. So it basically means, hey, they have room to grow its portfolio overall. So if this was like maxed out, I'd be like, hey, they need to either raise new capital, raise new debt, etc., in order to grow that liquidity pool overall size. Now, this is something they could keep either on the balance sheet internally and just service the loans internally, or B, sell the loans off to big banks itself and receive that cash payment for those loans itself once they're actual consolidated. Now, this I think is one of the most important slides of the entire deck. And this is looking at regional versus national pricing here. So we have like basically 4 different territories. So Florida, Virginia, California, and Texas. The actual full bar is basically the sales price or the average sales price. The actual kind of darker bar here is basically the acquisition price, like what they paid for the car to actually sell it, or what they could pay for the car to sell it. So what you're seeing right here is really this massive shift. I mean, it's all over the place for used car markets, and it's very much regionalized, which is really hard. Why it's really hard to capture kind of national, coast to coast kind of footprint. So basically what's saying here in high price markets on the right, they cannot acquire units at a basically target margin itself. Basically means they're overpaying for those cars in those higher price markets. And basically they can't source them internally. So what they have to do is they have to ship, basically buy cars in cheaper areas and ship them into like hot, basically hot markets itself and sell for that premium pricing, which shipment cost has a cost there too. It's not free to ship, coast to coast or even regionally, etc. Now, in low price markets itself, I mean, it's saying, hey, they overpay for the acquisition itself, so it's still a pretty high overall, basically cash payment to actually acquire the car, but also they can't sell it internally in that same region itself because it's a low price region. It's selling at a pretty low price too, so basically, hey, the margins there are getting squeezed pretty tightly in those low price markets. Now, the ideal scenario which you have here is inter-region or nationally focused. You basically move cars from like cheap areas to pricey areas and kind of meet that supply and demand itself and maximize your profit. Which, if you can crack that code, then it's like for Carvana, CarMax, Shift. This is everybody basically. If you can optimize that scenario and get the right car in the right price in the right market, you can make a lot of money very, very fast. The problem is it hasn't been actually executed very well by any of the companies so far at scale. So this is the last slide I want to cover real fast. So this is actually looking at unit economics. So I'm starting the very top portion of this. So e-commerce gross profit per unit basically means, hey, car sales price, does it make a profit versus the acquisition price, etc. That's all that means. This is also product gross profit per unit, which is basically like warranties, add-on services you can do, basically all those add-on things you can add on to the back end itself, which you combine these two numbers right here in the midterm goal they have, it's roughly $1,800, which again is a pretty low margin overall. They look at like Carvana, roughly gross profit per unit, it's roughly about $4,000. So they're about half of what they probably should be compared to like a Carvana, for example. Now, long term, they're expecting this will improve based on the optimization and all the other things I talked about earlier, etc. Now, that means, again, we'll see where this goes here, but this is not a massive profit increase. Really, the big profit increase you could see is the SG&A, really reduction goal right here, which is this is sales, general, administrative, OPEX expenses. So they're basically going to optimize logistics, optimize tiling registration by making it more like automated processes, more data science, etc. Marketing processes, optimize their marketing, which is a pretty kind of qualitative kind of factor there, but we'll see how they do overall. And obviously drop their fixed costs down, basically reduce their PP&E or basic property, plant, equipment down to the right size, to the right scale, and a regional focus itself. Now, what I'm saying right here is in the long term, they're basically going to grow their gross profit per unit on the top end by roughly $2,500 per unit. The bottom end for SG&A then grow up by roughly about $6,000 per unit. So if you combine that together, about $8,500 or so. So going back to the actual Excel sheet right here, this is basically loss per car. In 2022, it's roughly about $6,000, a little above $6,000. So again, if they actually optimize all these things, make all these things in the long-term trends, long-term changes, they'll make roughly around $2,000 or so of profit per car on a net income basis, which is their long-term goal. So again, even if everything goes very, very well, it's not much profit in the long term on a per unit basis, assuming all these things are optimized and all these things are actually executed on scale at the right time, etc. So I want to touch on the slide really fast, and this is actual net working capital, which all net working capital is basically cash needed in the business itself to finance, your actual receivables, your payables, kind of keep the business operationally running itself. So the idea here is if you sell off all your current assets, pay off all your current liabilities, which all the current means is 12 months or less, either receive the cash or you owe the cash. So you're seeing right here, it's positive right now. So if you take 800 or 1,800-ish million minus a little over 1,000 million, you basically $842 million. So again, this is a very, very positive number. If this went negative or went to zero, I'd be a lot more worried, but they do have cushion itself to maintain at least the current liquidity itself of the business itself to keep the business running at a smooth pace this next 12 months or so, if not more. Hey, that's the Investor Day presentation. If you're a Vroom investor, I missed a lot of data points. There's some of the finer details itself. Definitely check the deck out below if you actually want to see more detail overall. But obviously, I think Vroom right now financially, they're in a weird position because they're trying to cut down those costs and trying to really gain the profitability per unit itself. The actual national true vision they had, I think even a year ago, is probably either gone or on hold at least for 2 years or so based on this current credit crunch we have and recessionary fears we have right now. But yeah, that's really all I have. If you like the channel overall, be sure to sub in the corner right there. Also be sure to tap the like button down below as well too. But yeah, until next time, that's the exchange.